Yields. The gentlelady from California reserves. The gentleman from Missouri is recognized.
Thank you, Mr. Speaker. With that, we would yield to the gentleman from Kentucky, Mr. Barr, one of our bright, shining stars on the Financial Services Committee. 3 minutes.
Thank you, Mr. Chairman. And I rise in strong support. Thank you. I rise in strong support of H.R. 6392, the Systemic Risk Designation Improvement Act, and I applaud your excellent work on this bill. The ranking member, my friend, says that this is not about Main Street. Well, let me talk about what this bill is trying to fix, the problem we're trying to solve here. Dodd-Frank, the legislation that my friends on the other side of the aisle are defending, has produced this. Small business lending from banks is at the lowest level it's been in 20 years. More than 75% of corporate treasurers in this country say that federal regulations are stifling access to financial services. As a result, new business formation in this country is at a 35-year low. This bill is about Main Street because Main Street cannot access financial services because of Dodd-Frank. This bill is about fixing an arbitrary provision in the Dodd-Frank law that harms consumers and does absolutely nothing to stabilize markets. Dodd-Frank directs the Financial Stability Oversight Council to designate banks as systemically important financial institutions, or SIFIs. These designated institutions are subject to surcharges, additional regulation, and an implicit taxpayer bailout. That's right. Their bill is what gives Wall Street a bailout. What we're saying is, let's focus our attention on Wall Street, but let's give regional banks some regulatory relief so that they can serve their customers on Main Street. The primary test for systemic importance is this arbitrary threshold of $50 billion. Above that line, an institution is designated systemically important or too big to fail. Below that line, regardless of the institution's risky activities, it's exempt. This bill that we're supporting does away with this blunt threshold and directs FSOC and its constituent agencies to consider the institution's actual activities to determine if it actually is risky. If it's not, it deserves relief so that it can serve its customers better. Size is not the only issue. It's interconnectedness, it's risky activities. And many of these regional banks that serve my constituents in central and eastern Kentucky, not Wall Street, Central and Eastern Kentucky, farmers, small business owners, homeowners in Kentucky are being crushed and denied access to capital because of one-size-fits-all regulation from Washington. Unlike Dodd-Frank's arbitrary approach, this will better promote financial stability because it actually targets the enhanced regulation to where it belongs and not on Wall Street. Look, the bottom line is we're hearing from regional banks around this country, in central Kentucky and other places, that the expense of complying with these enhanced regulations and this SIFI surcharge means less capital for deployment in mortgages, in automobile loans, in small business loans. It means higher credit card rates. It means fewer customer rewards. It impacts these institutions' ability to engage in philanthropy and community development activities. Treating these regional banks as complex Wall Street firms is simply illogical.
The gentleman's time has expired.
These are not multinational Wall Street firms. These are traditional banks
that serve
Americans on Main Street. Thank you. I yield back the balance of my time.
The gentleman's time has expired. The gentlelady from California, the gentleman from Missouri reserves. The gentlelady from California is recognized.
I reserve the balance of my time.
The gentlelady reserves. The gentleman from Missouri is recognized.
Thank you, Mr. Speaker. With that, we recognize the gentleman from Pennsylvania, Mr. Rothfus, one of our more thoughtful members on the Financial Services Committee. Yield him 2 minutes.
The gentleman is recognized for 2 minutes.
Thank you, Mr. Speaker. I rise today in strong support of H.R. 6392. This bill, the Systemic Risk Designation Improvement Act, offers a common-sense approach to the process of designating systemically important financial institutions. In doing so, it addresses a problem that Republicans and Democrats have complained about for some time. Dodd-Frank's $50 billion threshold for identifying SIFIs is a crude and arbitrary way to decide which firms pose a risk to the stability of the financial system. It's important to remember that SIFI designation isn't trivial. When a financial institution is labeled as a SIFI, it faces enhanced regulation, supervision, and costs without regard to the nature of the bank or the bank's business. Accordingly, SIFI designation impacts a firm's lending ability and therefore the firm's customers and their customers' ability to thrive. If we really care about protecting financial stability and having a healthy financial system, we have a responsibility to pursue a fairer, more transparent, and more accurate process. The approach set forth under H.R. 6392 represents a more rational process for evaluating financial institutions as opposed to the Washington tradition of one size fits all. Under this bill, the Financial Stability Oversight Council will be required to look at not only the size of a financial institution, but also its interconnectedness, complexity, cross-jurisdictional activity, and the availability of substitutes. Keep in mind that banks designated as SIFIs today may still be designated as SIFIs under this new approach. This bill's reforms will inject the FSOC's SIFI designation process with greater clarity and fairness, and it will result in more appropriately targeted regulatory efforts. I commend Chairman Lukemeyer for his work on this important issue, and I am proud to be a co-sponsor of this bill in its original form. I urge my colleagues to support this bill, and I yield back.
The gentleman from Missouri reserves. The gentlelady from